All right. Okay, I want to welcome everyone to Forex Profits, where I am going to be teaching you how to scalp your way to $50 to $100 a day, or $200 or $300 a day, $500 a day. You might have $1,000 a day. It's all possible. I am your master trainer. I am Angela Powerhouse Williams, and we are going into session number 2. So, some quick housekeeping. I am not a financial advisor. I will not tell you what to invest in, nor pick stocks for you. This training is for educational purposes only. Please be aware that all trading transactions can result in potential loss, and you should only be trading with disposable income and not leverage more than you can afford to lose. Information disclosure: you may not discuss, share, reproduce, copy, reprint, modify, rewrite, create, distribute, publicly display on social media, publicly perform, license, or sell content retrieved or learned from this presentation without the express prior written permission by myself, Angela Williams, owner of Financial GPS 360, because I will sue, and I ain't trying to sue and have nobody in court, because I ain't trying to be in court either. But I just want to put that out there. To get access to this class is by invitation only. So if you know anybody who might be interested, please let me know. Everybody, new, old, it don't matter, should have your brokerage, your demo brokerage account already set up with Hugo's Way. Again, you're setting up a paper money account. It could be 100,000, it could be 10,000. You can even do $1,000 if you want to be able to see your discipline level and whether or not you are understanding the trade strategy. But everyone should have a demo account opened up. You should have MetaTrader 4 installed on your computer, and you should have your MetaTrader 4 installed on your mobile device. Everybody should have their charts set up, and your charts should look something like this, okay? So you got your desktop, and you're not, some of you may not understand everything that's on these charts, but in this week and next week, you will know why it is important. Your mobile devices should, they're not going to 100% mirror your desktop, because some of the indicators like the trend filter cannot be imported into the mobile, but you still should have your moving averages, your clouds, and your RSI already set up. Now, in today's training, I'm going to be spending time pretty much talking about the moving averages and the pivot points and the trend. Next week, we'll be talking about candles, we'll be talking about the Moogle cloud, and we'll be talking about RSI. So the 4th week, we'll have everything put together, and you'll understand what the trade strategy is, and you will be confident in taking your trades. So again, what we're focusing on is the cake. Yes, you can trade currencies, but I spend all of the training on indices, because that is what I trade the most. That is what I love. It pays me out the most, and it pays me the fastest. So we are trading the S&P 500. We're trading the US 30, which is the Dow Jones Industrial Average. We are trading the NASDAQ index, which is NAS 100. You also can trade XAU USD, which is pitting gold versus the US dollar. And gold literally has been taken off. So actually, you all could be day trading it. We also can trade the dollar future, and we also trade Bitcoin as well. Now, the reason why I picked indices, because the indices compared to currencies have more windows of when money drops into the market. So I know somebody asked me about some time frames, but 7 a.m. to 9:30 a.m. is where you will see majority of the money. 2 p.m. to 3:15 p.m., you're going to see money. 5 p.m. 6 p.m., you're going to see a move. 9 p.m. to 10 p.m., you're going to see another move. 1 a.m. to 3 a.m., you're going to see another move. And this is in Central Standard Time. So the time frames that you see listed on this slide is Central. So make sure you convert it to your time zone. But this is what we are focusing on. Okay, before you even begin to start trading, there are some research that you want to do prior to getting into the markets. And one of the research is you want to know if there's any economic announcements that may happen during your trading time that can make the markets move in your favor or out your favor. And so the first thing that you're going to do if you're trading currency pairs, like EUR USD. So if you're trading currency pairs, the first place you want to go to every day is forexfactory.com. You want to go to forexfactory.com. So if you're trading the open or a little bit after the open, you want to make sure that you're up early enough, maybe about 15, 20 minutes before the market's open. You want to have your computer set up. You want to have your charts out. You want to have everything that you need. You want to have went to your forexfactory.com, look to see if there's going to be any economic announcements, and write down the time that it is going to happen. So you want to already have this homework done before you even take your very first trade. So when you go to forexfactory.com, you're going to look over to the right-hand side. When you look over to the right-hand side, you're going to see this little, it almost looks like a funnel. When you click the funnel, you're able to actually filter out the currencies that you are trading. Okay, so for example, if I was trading EUR USD, well, obviously, I only want to know the news that is affecting the euro. You know, the euro and the USD, that's what I would want to know. So you can actually filter and select the certain currencies, find the date, and look and see what economic news is going to be announced and at what time. Now, what I do like for Forex Factory is they have these little impact envelopes, and the envelopes are color coded. So if you see a red envelope, that basically means that there's going to be, it could possibly be a serious move in the market because of that announcement. Okay, so when you see red, that means high alert. But obviously, I want to pay attention to anything that is not yellow. So in this case, you see an orange here too. So that's something you want to be mindful of. Now, if you are like me and you are trading indices, you want to go to Market Watch. You want to go to Market Watch, and when you go to Market Watch, you are going to search for the economic calendar indices. These announcements is what's going to be happening on a daily basis. So for example, today was Wednesday. And so at 2:30, you see at 2 p.m., there was going to be an open market committee announcement. And that's how, and the Fed was basically announcing some of the moves that they were going to make. And then at 2:30, the Fed chair, Jerome Powell, did a press conference. These announcements right here will definitely turn the markets. And if you look at your charts, you will notice these huge, long, engulfing candles that happen right when the Fed chair started talking. Okay, you never want to be in a trade prior, right before an economic announcement, because you could be in the wrong direction. Okay, and you could quickly blow an account, especially if you do not have your stop loss in place. So usually what I do is wait to the move end up happening, because usually what happens is whenever there's an economic announcement, it'll move the market, and as soon as it's over, it goes back to the position that it was prior to the announcement. So if you sit back and look at the markets, you will notice that. So I let the market do what it's going to do, and then I take a position and ride it back to where it was, okay? But you always want to know what is happening. So tomorrow is Thursday. So you see here, 8:30 is going to be GDP. 8:30, there's also going to be the jobless claims, which can move the markets. Now, with Market Watch, this is Eastern Standard Time. So if you are Central, these announcements happen at 7:30 in the morning. So if you're somebody that's trading at 7 a.m., you want to be mindful that at 7:30, it might be a shift. Okay, so just be aware of that. But this is what you should know. write the times down, or you can do an alert on your phone so you can be reminded, because a lot of times people be in trades and they be like, I don't know why this happened. And I'm like, I do. Did you look at the economic calendar? Also, you always want to make sure that you are watching the financial news channels. When I am trading, I always have CNBC on at the exact same time, because when the economic announcements happen, CNBC is going to announce it as well, but they're also going to kind of give you a temperature on how many of the expert analysts are taking the news. And so I'm always looking at CNBC. It is always on when I am trading. If you are trading after 5 p.m., then I recommend that you turn on Bloomberg News. And you might be able to go on Google, see if there's any live channels that will allow you to feed in CNBC. If by any chance maybe you don't have cable or you don't have access to it, there might be some live feed somewhere online. Just do the search for it. Here's an example of why you want to be paying attention to the economic calendar. This is an example of the market pretty much moving sideways, right? And right up in here, there was, you saw price action moving up, and let's say you took a buy position because you thought price action was going to move up. And then all of a sudden, President Trump decided he wanted to make a tweet. And he made a tweet in a way that it was going to affect the markets in a bad way. And what happened is you were in for a buy and the markets turned on you. The markets obviously turned on you. And so that is why you want to make sure you're not in a trade, because you see what happened after the announcement. Okay, it can affect your money. So make sure that you are mindful of when they are about to happen. Also, in our group under files, make sure you have downloaded the Powerhouse Scalp Trade Checklist. This checklist should be printed out. It should be next to you every time you're getting ready to take a trade. And you literally want to check the boxes off because it's going to remind you to go look at the economic calendar. It's going to remind you, okay, what is the daily looking at? It's going to remind you, do you got your resistance and support set up? It's going to remind you, are you taking the trades and the right trades? Okay, so make sure you have that checklist printed out. Now, my Powerhouse Scalp strategy is designed for you to be able to trade trend breakouts. That's what I'm doing. I am trend trading, but scalping at the same time. So scalp means I have the ability to get in and out pretty fast, but also if you follow the strategy and you get in a breakout at the right time, you can pull 50 to 150 pips from one breakout every single day. So let's talk about basic price action. So when you look at a chart, you see how you're looking at this chart right now. When you hear me say price action, what I am talking about is I'm talking about the candles. So whenever you hear me say, look at the price action, or what is the price action saying, what I'm saying to you is look at candles. So let's say, for example, you opened up a chart and you see these candles and you're in a 5-minute chart. What that is telling you is that each candle represents price fluctuation in a 5-minute interval. So each one of these candles, 5 minutes, 5 minutes, 5 minutes, 5 minutes, 5 minutes. That's what it means. When you see red candles, that means that price is moving down, okay? When you see green candles, that means that the price action is moving up. Okay, so that is just the basic. Green is down, red is up. Now, what you are about to see is, I don't like green and red candles, so my candles are color coded in colors that I like. So what you are going to see in these examples is actually what my chart looks like. But the premise is the same. You need to know what candle is going to be representing of price going down and what candle is going to represent price going up. And just remember that each candle represents the price going up and down every 5 minutes. If you're looking at an hour chart, each candle represents price going up and down every hour. You're looking at a daily chart, each candle will represent an entire day of price action, all right? Now, what you want to be able to do is you want to be able to pull up a chart and you want to be able to look at this price action and then say to yourself, what is the market saying to me? So the very first question that you need to answer is the market trending or is the market in a range? And I also call ranges sideways, consolidation. It all means the same thing. So sometimes if you are looking at the news channels, you may hear them say the market is in consolidation, all right? That's the same thing as when I say the market is moving sideways or the market is choppy or the market is in the range. They all mean the same thing. So it's either trending or it's not trending. So let's talk about trending first. Now, when it comes to trending, there are two patterns that I pick up on that I want to make sure that you pick up on. And basically, this is so that you will know when the market is trending. The first trend pattern is, I call it the paint roller. So let's go over to the left-hand side and go to the bottom. So let's say right here is the lowest price in the market. This is the lowest price. And it's let's say it's a green candle, okay? And so price moved up and then it stopped right here. And then it did a pullback, which means the price started to lower and decrease for a little bit. Now, where it stopped at created a new high because this was the lowest price, and then price moved up, created a new high. Then the price fell down a little bit, but notice the price did not go back to the lowest price point. It stopped and created a higher low. So anytime there's a pullback, the price was lower, but it's higher than the lowest price, okay? So when price moved up, it created a new high. Then there was a pullback and it created a higher low. Then after it did the pullback, it continued the trend up. So price action moved up and it created a higher high because it's higher than the previous high. Now, what you'll notice is that the markets never just shoot straight up. It go up, down, up higher, down, up higher, higher, okay? So it went higher, created a new high, and then it did a little pullback, which created a higher low. And then what did it do? It continued to trend up higher, created a higher high, pulled back, created a higher low, and then continued to uptrend to this highest point, okay? So to know that you are in an uptrend, you need to see higher highs and higher lows. And what you need and what you will usually see is 3 to 4. When you see 3 to 4 back to back, so you will see green candles moving up back to back. You will see a little bit of a pullback of red candles, and then you'll see green candles extend and go up more, okay? So anytime you see higher highs and higher lows, you are in an uptrend, but be mindful, it's usually 3 to 4. You are in an uptrend. Now, on the opposite side, how do you know you're in a downtrend? Well, obviously, a downtrend starts from the top. An uptrend starts bottom and goes to the top. A downtrend goes from the top and goes down to the bottom. So here's your highest price, and then the market started to short. It started to fall. So the price started to fall and it stopped here. And then there was a retracement. So there was a little bit of a pullback. So this area here where price fell to and stopped created a new low because it's lower than the highest price, right? Then there is a retracement because now it never just free falls unless it's an economic announcement. It's going to go down, pull up, continue down, pull up, continue down further. So that's what happens. So there was a retracement, but when it did the retracement, it did not go back as high as the highest price. So what it did is it created a lower high. Notice that. This is the highest price. It pulled down. It tried to go back up, but that higher price action was rejected. So it stopped here and it created a lower high. And then the downtrend continued and it created a lower low because it's lower than the first low, right? Then there was a retracement pullback, but instead of going back to this lower high, it stopped here, creating another lower high. And then what did it do? It continued on down trend, went down further, created a new lower low. Then there's a pullback, lower high, and then it fell down some more, went to its lowest point. So you know you're in the downtrend because the candles keep creating lower lows and lower highs. You should see 3 to 4. 3 to 4. You will know that the market is trending. So always be mindful when you see higher highs, you're in the uptrend, you see lower lows, you're in a downtrend. Uptrends start low, go high. Downtrends go high and then go low. So that's the paint roller. And and you'll know it when you see it. Because think about a paint roller. When you get ready to paint the walls, you don't just take the roller, put it in the paint, and go from the bottom of the wall to the top of the wall. That's not what you do. You go up a little bit, and then you pull it down so you can make the paint a little bit thicker. Then you move it up a little bit higher, and then you pull it down. You're going to notice this with price action, okay? So when you look at the market and it's trending, do you see a paint roller? Up, down, almost like a little jigsaw, like a kid was like a kid was going up and down on a piece of paper. That's what you're gonna see. Now, the second pattern that you will see in a trend, and I usually can spot this fast, is what I call staircases. This is when, if you're in an uptrend, remember uptrends always start at a low price and then move up. So what you'll see is that price will shoot up and then all of a sudden it looked like it's moving sideways in a channel. So it's almost up sideways, which we call sideways is also a range. It also means consolidation. So it shoot up, it moves sideways to the right, then it break out, shoot up to a higher high, move to the right, break out to a higher high, move to the right, and break out to a higher high. I usually can see this extremely fast. This is the easiest trend pattern to trade because you know after the market goes through consolidation or moves sideways, there's going to be a breakout to the continuation of the trend. So it moves up, right, up, right, up, right. Same when the markets are moving in a downtrend. Price action falls down, and then it's going to move to the right, almost like in a little channel. Move to the right, fall down, move to the right, fall down, move to the right, and then fall down to its lower price. Okay, so that's what you're going to see. You're going to see a move, and then you're going to see a right move where it seems like the candles are moving horizontally. And then it will continue whatever trend it started from. But regardless of whether it's a staircase or it's a paint roller, you should see 3 to 4 in a trend trade. Okay, so what you want to do is you want to be able to get in a trend trade before it starts, so you can make all the money going up to the top or all the money going down to the bottom. So you decide which one it is when you look at the markets, because if you understand the market structure, you will understand what you're looking at and you'll understand when to get into your trades. Now, remember, my moving averages that I'm going to be talking about tonight, my scalping strategy is based on trends. If the market is not trending, that strategy does not work. So the most important thing you have to know is what structure the market is in. If it's not trending, don't use the strategy, okay? Here's an example. Now, as y'all can see, I like pink and white. So pink means the price going down, white means the price is going up. As you can see, my background is black because I like calm. I like calm, yes, okay. So on the left-hand side, both of these are examples of price action moving down. Obviously, it is downtrend. As you can see here, price fell down, and then just like the paint roller, it retraced up. Fell down, traced up. Fell down, traced up, and then fell down. That's a paint roller. So when you look at the market, you can see it almost look like up in a downtrend, it looks like upside down V's. In the uptrend, it looks like a V, V's and W's. That's literally what you're seeing, V's and W's. That's what a pink roller looks like. But that lets you know, as you can see, it went down, one pullback, went down, another pullback, went down, another pullback. So you got 3 pullbacks. You should see 3 to 4 so that you know that it's trending. On the right-hand side, we got a staircase. Price action started up here, and then it moved down, and then it moved sideways. It wasn't like a pullback. It's sideways. It's horizontal. Fell down. Price action moved sideways, almost like in a little range. It moved sideways. Fell down again. Moved sideways. Fell down. Moved sideways. Fell down. Okay, so this was literally 3 to 4 sideways. So you know you're in a downtrend. Okay, so these are examples. So make sure that when you're looking at your charts, and what you have to do is you have to zoom out. A lot of times you all are zoomed into your chart so that your candles are big. And you are not realizing that you are not in a trend market because you are zoomed in. You have to zoom out so that you can see the patterns, okay? So here's, again, paint roller, staircase. So let's look at price action again. So right here, again, each one of these candles represent price action at a point of time. Okay, so this right here is a 5-minute chart. Every candle represents 5 minutes of price action. For this example, green price up, red price down, right? So if you thought the price was going to move up, obviously you want to get in a candle from the bottom when it first starts to form, okay? So if you get in the candle here, and the candle moves up to here, all right? You got down here at the price of $24,262. When this candle moved up to this line here, it went to $24,295. So that means if you did a buy down here at the bottom of this candle, because you thought the price action was going to move up, the difference between these two is 33 pips. 33 pips. This move right here is 33 pips, and this is 5 minutes. So there's money that can be made when you understand the power of the candles, okay? But let's say, you know, price action moved up, and right here you decided to take a short because your indicators tell you that price action may be about to fall, okay? So clearly, if you want to short the market, you want to hit sell at the open of the beginning of a red candle. So let's say you got into this candle right here, right at the top, and the price is 24,344. Now, when you get in a position and short the market, it is with the expectation that the prices are going to go down. That's how you make money. The difference between where you got in at and where you got out at is the money that you make when you're in the right direction. So obviously, we don't have to buy and then sell. We could just sell. So if we think prices are going to go down, we hit short. If we think prices going to go up, we hit buy. In this case, right here at this candle, I want to short. So I'm going to hit short. So I'm in position at 24,344. And let's say I just rolled it down because I got in high enough. You always want to sell high, right? So I want to sell high. We'll talk more about the wicks of candles and things like that next week. Next week is candlesticks. So you get in here, and let's say you rolled it all the way down. You let the price action go all the way down to the bottom here. And when you got done, the price had dropped to 23,995. That means that, well, clearly you were in a downtrend, and that's 349 pips. And so the point of my strategy that I'm going to talk about is for you to be able to get in at the beginning of a trend and be able to ride the trend down. You can scalp and get in and out, but if you get good positioning and good timing, and you catch a strong trend, you can make a significant amount of money in clearly a shorter period of time. The same thing if it's an uptrend. Remember, with an uptrend, price action always starts low and then it moves up. So in this example, I'm going to do a buy right here. Like I said, next week we'll talk about candles, how these candles are are created, what the wicks mean, and what it's going to mean to you. So we will talk about that next Wednesday. But let's say I did a buy down here at the bottom because my indicators is telling me that the market is about to move to the upside, right? So if I did a buy right here at the price of 24,063, when I do a buy, I am assuming that the price is going to increase. It's going to go up, right? So I'm buying low. So price went up, went up, went up, and it ended up all the way up here at 24,365. I'm in an uptrend, clearly, and that's 302 pips. Okay, that's 302 pips. Now, this is the other structure that you may see, because if the markets are not trending, they're ranging. And this is where I think a lot of people are getting caught up. Again, because you are zoomed into your candles, you do not realize that you are in a consolidated market. You think that the market is trending and it's not. And so you're taking buy and sell trades, and as soon as you get in, it's turning and reversing on you. It is because you are in a range and you are consolidated. You have to zoom out your charts. I cannot stress that enough, so that you know what the market structure is. And so basically, a sideways market, choppy market, ranging market, literally moves up and then fall back down. Move up, might create a higher high, fall back down, create a higher low, but then it goes back up to the same price point as the previous high. It doesn't create consecutive higher highs. It falls way back down to the bottom. Then it go up. Then it go down. It go back up. Get close to them to them previous highs, and then it fall all the way back down to this previous low, and then it go back up. What you're seeing is that it's not creating higher highs, it's not creating lower lows, it's just up and down, up and down, up and down in a range. It's literally, if you look at all the price action, it is moving sideways, okay? And so what you have to do to know you're in a range is you need to draw a line, a horizontal line across the top of the price action, which would be resistance, and a horizontal line at the low at the bottom, which would be support. And you literally can do that when there's a range, okay? So you see it here. It's in a channel. I call it a channel, but they call it a range, okay? And this is where price action is going from this low of the range to this high of the range, back to the low of the range, back to the high of the range. You need to know this, because when it is in this type of structure, the moving averages do not work. So you have to know that. And what you have to do is wait for the breakout in one of the directions, okay? Because usually if the market is in an uptrend and then you see this move to the sideways, that means it might be a staircase. And so afterwards is going to be a breakout to the upside. The same if you see it in a downtrend, the breakout will be to the downside, but you have to wait for it. Now, normally, I tell everybody don't trade. When the market is moving sideways, just don't trade. Why? Because the moving averages don't work. So why would you be trading if you're moving sideways? Okay, but what I want to do, what I do want to do is just show you how to trade it for those people who do want to be able to make money even in a range, okay? So again, when you're looking at a range and you can see it, draw a line across the high points and draw a line across the low points. And you'll know what the highs are because you'll see multiple candles that touch that line, and then the higher prices was rejected. You know it's rejected. Look at these wicks. When you see wicks on the top of a candle, that means that higher price is being rejected. So it's being rejected. It keeps falling. Every time it go up here, it keeps falling. Look down at the bottom. See these long wicks at the bottom? That means that the lower prices are being rejected, and it's staying in this range. So look at it. Price action pushed up, pull back, pushed up. That's all you see. Up, down, up. You don't see a new up, a new down, a new up going higher and higher and higher. You don't see that. You see a push up, pull back, push up. Fell down, move sideways, fell down, move sideways, fell down. Pushed up, fell down. Pushed up, move sideways, pushed up, fell down. When you keep seeing this, this is a choppy market. This is a ranging market. This is a sideways market. You usually only see one higher high or one lower low. You do not see 3 to 4 of them. You do not see 3 or 4 of them. That's another way to know that you are in a range. So when you're in a range and you understand you're in a range, it's actually easy to trade a range. So here's another example. Price action moving up and moving down. Now see, you looking at this and being like, man, this got to be an uptrend right here. Price action moved up, but then it moved sideways and then it fell back down. No, that's not an uptrend, okay? Even if you looked up here, price action moved up, fell down, moved up. That's it. Went to the side, fell down. So these are not trendings. These are just markets moving sideways. So once you draw your horizontal line at the top of the price action and the bottom of the price action of that sideways range. When price action hit the bottom band, which would be considered support, when you see a candle create a long wick at the bottom, buy. You can buy off this bottom range with the expectation that at some point it will go to the top, but you can scalp it. Buy, stay in until you get some wicks at the top, get out. Another option, it fell back down on you, went back and tested that low again, created the long wick, then you got a bull candle here, buy, scalp, okay? On and on. When you get to the top, you see the wick at the top of the candle, you short and go down with the expectation that it might go back down to this bottom. Price action will stay in this range until there is enough volume, enough money to hit the systems to push the candles out of the range. Now, again, just because the price action hits this bottom band, do not automatically go in with a buy. Wait for that confirmation candle with that long wick at the bottom and price action starts to push back up. Then you get in with a buy. Same with a sell. If the candles are going up here, you don't know if it's going to push through and keep going up. So you're not going to hit a sell until you get a confirmation, which means you see a candle with a long wick and it's red. It's a bearish candle and it starts to push down. Then you're going to short, okay? So just be mindful. If you're going to range trade, draw the box, because it's literally, that's what it is. The price action, you can literally put it in a box. And you buy the low, you sell the high. Buy the low, sell the high until candles break out of the box and continue the original trend, okay? Like NASDAQ, I think NASDAQ last week for at least 3 days. I think it was NASDAQ and the US 30 for at least 3 days. It traded sideways. And so a lot of people were saying, well, you know, I think I was losing money in my demo, or it could have been a live account. And I would see people say I'm losing, and in my mind, I'm like, but there was no trade. So how are you losing? So that means that your candles are zoomed in, and just because the candle crossed over the moving average, you were taking the trade. But then when you took the trade, it was falling on you, and that was because you didn't realize you were in a range market, okay? And so I need to make sure that you understand market structure. The moving average lines only work when the market is trending. When it is not, you cannot use the moving averages. If you either do not trade, or you buy at the bottom, draw your resistance and support for that little box area, buy off the bottom, sell off the top. Okay? So that's it. Don't trade it, or understand how to trade it. But you got to know when you're in a consolidated market. Now, market structure also can change on you, okay? There is no uptrend forever. There is no downtrend forever. It has to go between uptrends and downtrends, all right? So I want you to be able to recognize it. So on the left-hand side, here's an example where, let's say there was a previous downtrend. This is the bottom lowest point. It started to push up. So price action started to push up, created a higher high, did a pullback, created a higher low. And then it pushed up some more, created another higher high, and created another higher low than the previous higher low. And then it pushed up some more, and then it created another one and pushed up at the top. Now, for some people, especially if they didn't get in at the bottom, they tend to do what I call chasing a candle. And that is, you see that you're in the uptrend, so you just assume that you can go in for a buy up here at the top. That's chasing a candle, all right? And look what happened. You do a buy here, and then instead of it pushing up and creating another higher high, it falls down and it creates a higher low. It pushes back up, but it don't go as high as the highest point here. That is an indication, that is your first alarm that the uptrend market structure is shifting and changing, okay? So if you're in a bad trade, get out the trade, all right? Because it's not actually gonna go higher. When it creates this new high and it's lower than the previous one, it's shifting down and it's gonna fall down some more, create a new lower low, push up a little bit, create a new lower high, which is lower than this one. And that's just letting you know that the uptrend has ended and the downtrend is starting. So always be mindful of how market structure works. Even if you're in an uptrend, it's not going to last forever. Be able to identify when a trend is ending, okay? Now, obviously, there are some reversal candles that you're gonna learn about next week, which will help give you an idea, but just looking at the structure in a whole, you still should be able to see it. So on the right-hand side is an example of the market gonna begin a downtrend. So price action fell, there was a retracement pullback, it created a lower high, which is lower than here, fell down and continued the trend, created a lower low, pull back, created another lower low, pull back, and then created another lower low. Now again, for people who don't understand market structure, you are assuming that it's going to continue to short. So you hit sell down here. And what does the market do? It does a pullback and then it goes back down, but it doesn't create a new lower low. It creates a higher low than the lower low. And then it starts to push up. That is going to tell you that the downtrend, the bear trend is over and a bull uptrend is about to take place. I want you guys to study the market structure. Now, the one thing I always say is that you should be looking at your charts every single day. If you look at it and you zoom out, you will see everything that I am telling you. You will be able to pick up when the market is shifted on you. So even if you're in a bad trade, you can get out that trade, because many times you get in a trade and you know it's the wrong trade, and you're praying that it goes in your favor, and the whole time the market structure has changed. No, it's not going to go in your favor, and you can end up blowing your account. So I want to make sure that you spend time just studying, just look at it. Do you see it? Look at it. Again, here's an example, because tonight I wanted to spend a lot of time on market shifts, market structures. So we were in an uptrend. The market went up, pulled back, created new highs, pulled back, created new highs, pulled back, and then check it out. Right here, you see how it didn't go as high as this wick here? This is the highest price point. So this candle did not break past this wick. So that means that it created a high, but it is at a higher high. And then what happened after that? It pulled back, it went up, and it created a lower low. Here's a lower low than here, and this candle is lower than here. So literally, if you drew a line across, you will see that the uptrend is breaking and the downtrend may be coming, all right? And so what it did is it broke down and then it started moving sideways. There's no lower lows, there's no higher highs, it's just sideways. You can literally draw a line at the top, draw a line at the bottom and know that the market is moving sideways. You're not trading, or because you marked it off, you buying from the bottom, selling when it get closer to the top. And then you're waiting for price action to break out the box and continue the trend to the upside. Okay, so this is an example of an uptrend that turned into sideways. Okay, so always remember, the market is bullish when you see consecutive back-to-back green long candles. When you see higher highs, higher lows, you are in a uptrend. Clearly, if you see consecutive back-to-back red candles and they are creating lower highs and lower lows, you are in a downtrend. Anytime you're seeing candles and they're not making higher highs or higher lows, lower lows, it is moving sideways. So you either caught this breakout to the upside, and when you see it moving sideways, just don't trade. Just don't trade. Sit back and watch, because you already know that after a market moves sideways, there's going to be a breakout to the upside or the downside, and you could just trade the breakouts. But if you want to practice trading a consolidated market, a sideways market, draw your box, buy off the bottom, sell off the top, and wait for a breakout candle. Here's another example. Market went down, moved sideways, it fell way down, did a pullback, fell down some more, and then it moved sideways. And then after it moved sideways for a while, it broke down and went down. We got we got a reversing candle, and then price action started to move up. And that's really letting you know that the structure had changed. Okay, so it went down, moved sideways, broke down, pushed up, moved sideways, started to create higher highs. The downtrend has been broken. And if you look at this candle, 5, 10, 15, 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 1 hour, 5, 10, 15, 20, 25, 30, 35. Y'all see how long that market was moving sideways? I have seen sideways markets that lasted the entire day. But after that, there'll always be a breakout to the opposite side. Okay? Here's some more market structure. Market was sideways, it pushed up, then it fell down. Pushed up, fell down more, then it pushed up, moved sideways, pushed all the way up, fell down, pushed up, fell down, sideways. This is an example of a consolidated market, because there is only literally one higher high or lower low at any point in time. And then eventually it broke down, moved sideways, broke down, and then it went up again, it moved sideways. This is choppy. This is choppy. But all you're going to do is draw a line across the top. You can draw a line across the bottom. When the price action hit of the low, buy. Once it hit the top, short, go down, buy. As long as you understand it, you'll know either to not trade, or you'll know how to trade it. Again, markets uptrend, and then it moves sideways. But if you got your candle zoomed in, this look like the market is moving an uptrend, then a downtrend, and the whole time it ain't. It's just up, down, up, sideways, down, up. It's not creating higher highs. It's not creating a bunch of lower lows. Remember, your higher highs and your lower lows, you need to at least see 3 or more for it to be trending. It went up, sideways, up, sideways, up, sideways, then up, down, up, down, up. Then it broke out. Pull back, up, pull back, up. Okay, so just be able to understand that, and that's why I just wanted to put more pictures in here so that you can see it. But as you can see, I had to zoom out to see it. If you zoomed in, you're never going to see this. Okay, so let's talk about my strategy. So tonight, I'm going to be talking about the moving averages and the trend indicator, the moving average, the trend indicators, and the resistance and support indicator that you should have imported into your chart. Next week, we're going to talk about candles. We're going to talk about the Moogle cloud, and we're going to talk about RSI. Okay, so let's talk about the breakout strategy, which is designed for you to catch trend trades. So always remember the steps, but if you got the checklist takes these steps and just shrink it down some and keep it real simple for you. So make sure you print out the checklist. But you want to check out the economic news. What you also want to do is you want to go to the daily time frame and you want to look at the very last candle, the last previous candle. So when you're looking at the daily, the last candle on the chart is what's happening right now. The candle before that is what happened yesterday. So I want you to pull up the daily and look at what happened yesterday, because usually what happened yesterday is pretty much going to happen today. Okay, so you want to know, is the market moving up or the market moving down? The next thing is using higher time frames. You can use the daily, you can also use the 4-hour. You want to map out what we call critical resistance and support. And that's just going to the top of the candles, drawing a line across, going to the bottom of the candles, drawing a line across. Now, what I usually do is for my critical points for resistance and support, I change the color. I make mine pink. You know, it's just so that I can see the distinction between the fib resistance and support and the ones that I actually manually drew. Okay, so map out critical resistance and support. Then again, we got our fib indicator, which is an indicator that you should have imported onto your charts. So again, if you have not set up your charts, you want to make sure that you do that. Under the files, there is a video that shows you how to set up your charts for trading. Now, I am going to have somebody who's going to bring their Android phone to me, and I am going to do a video on how to set up your charts if you have an Android. There is already a video under files on how to set up your charts if you have an iPhone, okay? So there is an indicator that you're going to import on your desktop chart. It is called the fib resistance and support. So basically that indicator is going to draw resistance and support for you. Sorry. Okay. Next is the 2-candle trade confirmation, and we're going to go over that in just a second. And then there's take profit and risk management, and we're going to go over that in a second. And as always, anytime you trade, you always want to track your results. And just remember, if you want to trade a sideways market, what I talked about is basically drawing out the range, the top or the bottom. Another method that you could use is you could use an 8 moving average. But what you will want to do is set up a total different chart, rename it sideways, take the 200 moving average off, and replace the 50 with an 8. And so you can do, if you want to stick to the lines, you could do an 8 moving average and trade a sideways market. Me, I prefer drawing the top, drawing the bottom, and buying off the bottom and selling off the top. To me, that's easy. Drawing a box makes it so easy for me to trade a range market. So let's look at the strategy. Again, the strategy is designed for you to catch breakouts. And so the way the strategy works is you got 2 lines that is going to be on your chart. These are called moving average lines. These are exponential moving averages, okay? And the first line that you're going to draw, which is purple, and again, when you watch the video, I show you how to do this. The first purple line or fuchsia line is the 50-day moving average. And all it's doing is going back and looking at the last 50 candles and coming up with an average and drawing a line. That's pretty much what's happening here. The 50-day moving average always represents retail traders, you know, which are short-term traders using the 50-day moving average. The yellow line is the 200-day moving average. So again, it's looking at the candles, the last 200 days, and creating an average from it, all right? Now, the 200 represents institutional buying, and that is the hedge funds and big institutions, all right? Now, where I want to go now, even though they're moving averages, we are using the exponential moving averages. I like to use exponential moving averages because they put more weight on the current candles. Okay, because what you'll notice is that all indicators are laggers. That means that indicators cannot predict a future move. Indicators can only go along with the previous candle and behind, okay, and past, I'm sorry, previous candle and past candles. It cannot predict the current candle. So no matter what indicator you use, okay, you can use moving averages, you could use Bollinger Bands, it does not matter, MACDs, RSI, it does not matter. They are laggers. The only thing that can tell you right now what's happening is a candle. A candle, which is price action, is right now. But we are adding these indicators to get an idea of where the future could possibly go. But there's nothing that is 100% going to tell you where the markets is going because we don't know. This is big money. We're trying to follow big money, okay? So we got our 50-day moving average. We got our 200-day moving average. Hopefully you can see these lines. They're kind of faint because my background is black. But you see these green lines. You see this blue line. If you look down here, you see some red lines. These are our Fibonacci resistance and support. So this indicator will automatically draw resistance and support. And resistance and support is pretty much looking at the highest prices, the lowest prices, and in between where multiple candles hit a certain price and pause. Basically, that's what happens. It pauses. And so what we're doing is we've added an indicator called the trend indicator. This trend indicator is telling you the trend for the time frame that we are looking at. Now we are trading off of 5-minute charts. So again, each candle represents 5 minutes of time. This trend indicator represents whether or not we're in an uptrend where it's green, downtrend where it is red, okay? So here's what you want to do. You are waiting for these candles to cross, and this is an example of if you wanted to do a buy and you wanted to go long, when do you buy? So you're waiting for candles to go up from the bottom. As these candles push up, it pushed over the yellow line. When one candle crosses the purple line, so it is above the yellow line, it is above the purple line. When this candle crosses this line and it closes, the body closes, when that body closes and is still above the purple line, the very next candle, when it opens, it have to open above the purple line. You hit buy. Now you're not waiting for this candle to move up and then you buy. As soon as the candle open, the little line of the next candle open, as long as that line is above the purple and the yellow, you hit buy. This is your entry point to buy right here. This at the beginning of this candle right here. So we're doing a 2 candle confirmation. The first candle crossed, you see this bullish candle is white. So this example of seeing a green candle. The white candle crossed over. When it closed, the body was on top. Here's the body. When it closed, it was on top. That's the first confirmation. The second candle opened here. And as you can see, when it opened, it was still above this fuchsia line, right? You hit a buy, just hit buy. Now, we know that the market doesn't just go up, up, up. It go up, it pull down, it go up, it pull down. We know that already. So down here, we're in a buy. It hit our criteria. This is your first entry. This is the initial breakout entry. Can buy. Now, your Fibonacci's, which is your Fibonacci resistance lines, when the markets is moving up, the resistance lines are green. You are going to use these lines as your take profit of when you should be thinking about getting out of a trade. Like, we are scalpers. That means once you get in the trade, you have the ability to get out your trade when you want to get out your trade. But I want you to be able to get as much profit as possible. So if you catch the breakout and you're not in a sideways market, it should move to the take profit points, because big money is looking at these take profit points. So you did a buy here with the expectation to leave it open, and this line here, that's your first take profit. That's your first take profit. If you want to get out of a trade, you take your profits here. So you buy low, you sold when it hit this take profit, right? Now, once you could have hit buy here, and once you saw that this candle crossed above this take profit, you could say, hey, you know what? I'm going to hold it open and see where it goes, because I got in so low at the initial breakout that I'm going to sit back and I'm going to ride the trend. Okay, and so it moves up, and it went up. It went way up here. So if you got down way down here and you went way up here, you made a whole lot of money, right? But sometimes you're going to get in a trade and you're going to get scared. You're going to get scared, right? And let's say you got out at this take profit. You still made some good money. From here to here was a good move, all right? So let's say you got out this trade. Once you get out of a trade, do not jump back in a trade, because that's when you're chasing a candle. So once you get out, you have to wait for the candles to do their pullback, because when they do the pullback, it'll come closer to the 50 moving average, which is the purplish fuchsia line. Then you can go in for a buy for a continuation trade. Okay, so the market, this is the initial in, up, here's a pullback. Then you see this big bullish candle. This is another opportunity to get in for a buy. It went up, pulled back, it went up more, it pulled back. This is another opportunity to get in the trade. See how that pullback came a little bit? You see how the candles are way out here? And then with the pullbacks, it kind of moves closer to the moving average. Sometimes it touches the moving average and then continue the trend. But that's what you're waiting for. So if you did an initial breakout and then you got out too soon, you have to wait. All right, you guys, you have to wait until after the pullback. That's what you got to do. Now, if you come into the markets and you realize you missed the initial breakout, don't jump in, wait for the pullback. That's all you got to do, is wait for the pullback. As long as that bottom indicator is still green, that means you're still in an uptrend. So that means you can buy the pullbacks. So what is the breakout strategy? It's based on price action, candles. When the candle is from the bottom. It came up, it crossed over the yellow line, it crossed over the fuchsia line, and closed above the fuchsia line. When the candle right after that opened up, if that candle, when it opened, still was above that fuchsia line, you hit buy. You use your take profits, resistance lines, or when to close a trade. If you get in early enough, you can ride it all the way to the top. If you get out early, wait for a pullback. And as long as the trend is still in your favor, you go ahead and you can buy after the pullback, okay? That's why it's so important that you understand if the trend is a paint roller or stair step. If you know that, then you'll know how to buy the dips, okay? This is an example. I don't know why my indicator just really froze on me. But anyway, this is the market going down. So again, you see these red lines here that's being created? These are support. So when price action is going down, these lines are support. When the price action is going up, the lines are called resistance, and they are green, all right? So as long as the candles, if the candles are in between the yellow line and the fuchsia line, you're not trading. Do not take a trade when the candles are in between the lines, okay? So in this example, you see the 1 and the 2 here. You see how this candle, which is the first candle, it fell, it started to fall below the purple line. It's below the purple line and it's below the yellow line, okay? So the yellow line on top, which is the 200, we got the fuchsia line here, that's the 50. The candle crossed it below and it closed. That's the first candle confirmation. The second candle, when it opened way down here. So it's clearly below the 50 and the 200. At the beginning of the opening of this second candle, right here, you hit sell. Just hit sell. You hit sell, and when you do, this is a take profit. This is a quick scalp from here to here. That's a quick scalp, all right? Because that's one support line. So that's take profit. But look what happened. It went down, it did a little pullback, and then it fell down some more. Hit the second take profit. That's why I use these support lines as my take profit line. So I can stay in the trade because you got in way up at the top. So because you got in up here, you got time to leave it open to see where it goes. Now don't let it come all the way back to you and take all your profit and then go into the negative. That don't make sense. All right. But if you get it in early enough, you can hold it open a little bit to see where it go, to see if it go to a second take profit, which it did. But because you got in so early, you can leave it open. Let's see where it go. Well, guess what? It went all the way to the third take profit. Institutions, they got these lines marked off just like you got the lines marked off. And that's usually where they're taking it because they're trying to get the most money, right? So you had 3 take profits. Now, if you got in and you scalped and you got out at the first take profit, you trying to figure out when to get back into the market. As long as that trend indicator is still red, you're waiting for a pullback. Here was one. This was a pullback, and then it's a continuation of the trend. Went down, went down. Then we did a major pullback, got a little bit closer to this 50. I like that. I'm gonna hit sell. Continuation trend, all right? And then it started to move sideways. Like right now it's sideways. So this was the downtrend. You could have got in here and you could have got in here if you missed it or you got out too early. So again, if you get out too early or you missed the initial breakout, as long as the trend is still in your favor, wait for the pullback And then when you get that red candle to continue on down, just hit sell. Now, what you'll also notice is what we call when the lines actually cross. And I think that this was a confusion for a lot of people, because I think a lot of people thought that the trade strategy is just when the line cross. No, the trade strategy is when the price action cross. The cross was just another form of letting you know which direction the trends could be moving to. So right here, if you notice, you would have been in this trade. This trade met the criteria. This candle right here, it crossed below the yellow, is below the 50. And this second candle, when it opened, again, it is below the yellow and the 50. So you'd hit sell way up here, right? So you're already scalped. You already scalped, you already is in a trade, okay? I don't know why my thing right here don't want to work for me. My spotlight don't want to work for some reason. But anyway, you're in a trade, you scalped. And you see this blue line here, that could have been your take profit, all right? But as you pushed up, you see how these lines crossed over? You see how the 50 crossed underneath this 200? That is called a death cross. That is just letting you know that the move to the downside is going to be a deep move, a long move. And that's what happened. As you can see, price action fell down. It did a pullback, got close to that 50. But because you saw that death cross, you are confident in taking that short, because you knew exactly what was going to happen. It was going to fall down some more. It did a pullback, got into this 50 again, short, it went down all the way to here, push back up, but this time it broke past the 50, it went all the way to the 200. You see this long wick here? Indication of higher price rejection. It fell back down, but you wouldn't even did this trade because it's in between the bands, right? But you would have did this one. This was the initial, got out. You definitely would have took this one because of the cross. So you just shorted, and you literally, because you got in up here, you could have left it open to see where it go. Even though it pushed back, you could have still been in the trade. It went all the way down here. Or you could have been in up here because you got the initial breakout, and you could have been right here and left it open and went all the way down to the bottom. Either way. But remember, the initial strategy is the candle crossing the candle. Remember, we care about price action, the right now, what's happening right now. What are they doing right now? That's what the candle represents. When the candles cross, that's letting you know where they are going. Okay, and then with the cross, when the 50 crosses underneath a 200, it's a death cross. That means there's going to be a strong move to the downside, or it's going to continue trending down. Or if the 50 line crosses above, from below the yellow line, then that is a bullish cross. And that just means that the uptrend is going to be a bigger move to the upside, okay? A continuation of the trend. And it is confirmed with your trend indicator at the bottom, because clearly it is red. Do not counter trade. I don't want anybody counter trading right now until you have mastered the strategies. Counter trade is when you think you know what the bottom is or something, and you're trying to do a buy because you think it can't possibly go no lower than this. Yeah, don't do that. That's what counter trading is, when you're buying when the trend tells you to short, and you are shorting when the trend is telling you to buy. Do not trade against the trend. That's like standing in front of a train. You don't want to stand in front of the train. You will get ran over. You want to get on the train and ride the train. So trade the trend. If you go against the trend, you'll find yourself losing more than you are winning. The only time I'm doing counter trades is when the market is ranging. When the market is ranging, yes, I can buy low, sell high all day long as it's ranging. But if the market is trending, do not do counter trades. You'll lose all your money. Okay, so let's say here's another example. All right, and this is where you can have multiple, you can take multiple positions in the same direction. Okay, so let's say, for example, the market, looking from the left hand side, the market moved up, right? It moved all the way up to a top point. You see this long wick at the top, which is telling you that price action at a higher price is being rejected. So it's about to be a move to the downside. And let's say you decide right here, I'm going to short the market. I'm going to hit sell. And I'm going to get into this red candle at the top. So when you hit sell, what you're going to do is you're going to use the point right above this highest point where this wick is. You're going to make that your stop loss. Okay, or you can use the previous support line. Okay, your previous support line that was higher price, you could use that as your resistance, your stop loss. Okay, so here's my top here. I think the price action is going to fall down. I got my stop loss right here, right? And I'm going to hit short. I'm selling because I have the expectation that price is going to move down. My support lines is already drawn for me automatically with the indicator, okay? So I hit sell right here. This is my first take profit. So when price action hit this line, I can close my trade and take my money if I want to. I can ring the register. Or because I got in at such a high price, I can say, you know what, price action is going to continue to go down. Now I'm not going to get out my trade. I'm going to stay in this trade. All right, so this trade is still open. When it pushed down to the second take profit, as soon as it showed an indication that it's going to break through my second take profit, I can hit sell again. So now I got 2 sell positions open. Okay, so that's more leverage. As it goes down to the third take profit, because I'm in a deep downtrend. Now I could close out both trades, but if I see that the price action is breaking through this take profit, I can hit a third sale. And I can have 3 sales positions open, which will allow me to create more leverage and make more money. And I could go all the way down to this fourth take profit, because that's literally what happened. If you got in at the top early enough, you was able to ride the wave all the way down. And you literally could have hit the sell button, sell, 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 and had 3 sell positions open. So a lot of times, you know, people trade with higher lot sizes because they're trying to get more money. But if you get into a trend trade at the right time, all you have to do, you can start with a low lot size and just as it knock out your supports, take another position, take another position. And so you got 3 positions open. So it's like you did the trade 3 times. So obviously you're going to make 3 times the money, right? So that is just another thing that you could do. You can have multiple positions open. Okay. And so that's basically how you do it. So basically when it comes, like I said, when it comes to stop loss, me personally, I use the resistance and support as my stop losses. So if the price action is moving up, the last support line that we took out is going to be my stop loss. Now for some people, your stop loss might be a little bit tighter. You might have a stop loss based on how much money you got in your account. I have a little bit more money in my account, so my stop losses can be wider. So it just depends. And so what I want you guys to do, your homework assignments, if you don't already have your chart set up, I need you to set your charts up. What I also want you guys to do is I want you guys to start identifying market structure. So tomorrow morning when the markets open, I want you all to drop in the group what you think the market structure is. Is it a downtrend? Is it an uptrend? Or is the markets moving sideways? I want everybody to drop that into the group tomorrow so that I can see that you can identify market structure. Also, take a trade. If you have not taken a trade yet, I need you to take a trade at least by Friday. And obviously, when you take your trades, whether you win or lose, drop them in the group, because even if you're losing and you don't share it, we don't know that you're losing. So if we don't know that you're losing, we don't know if we can help you, right? So that's what I want you to do. Always share your wins and your losses. Look at market structure. Let me know what that is, okay? So I'm making sure that you understand that, because I believe that once you master market structure, the trading part is easy. Now, the last thing that I want to talk about is I told you guys that professionals track, and that means that every time you take a trade, you should be journaling it, okay? And now for me, for a very long time, I journaled in a notebook. So I have a notebook full of entries, okay? And then I also would screenshot my chart in a trade, and I'll have them on my computer, and then I go back and look at the markets, and then I start to notice patterns. I start, be like, man, I seen that setup before. I'll go back through my pictures and be like, I knew I seen that setup before. This is what is going to happen. That's how you start to be able to feel the rhythm of the markets. You got to track it. And so, but I did find this awesome tool that will allow you to literally automate your trading journals. So again, if you like to use paper, continue to use paper. This is a company, they're called Airtable, and this is an online database. And what I like about Airtable is it's almost, the functionality is, it's a, how would I want to call it? It's like an Excel, like an Excel spreadsheet and a database all combined together, okay? And you're able to journalize your trades. You can put your profits. It will add your profits up for you, and it will store your pictures or your screenshots of your trades, and you'll be able to go back and look at them. So Airtable, they have a number of different options. This is the free version. So you all can go to Airtable. You can set up an account, pick a free one. And what I'll be doing tomorrow is I'll put together a quick video tomorrow because I am going to try to share my journal with you guys. I'm gonna share with you the link. And so I'm gonna show you how to import that link into your Airtable, and you'll just be able to use the exact same format as I use, okay, to be able to do your trades. So I am going to see if I can go over to Airtable. Okay. So this is what it looks like. I want somebody to type in the group chat if you can see my Airtable. Can you see the screen? Somebody type in the chat if you can see the screen of my Airtable. All right. Thank you, thank you, thank you, thank you. So this is what it's going to look like. I have two little databases in here. We got one for futures and I got one for Forex. So what I'm going to do is I am going to create a link, like I said, a video. So tomorrow you'll know how to do it. Go ahead and set up y'all Airtables. But this is what it looks like. When I pull up my Powerhouse Scalp table, this is, it's almost like a little journal book. And the great thing about it is the date is in here, whether or not you did a long trade, if you did a buy, if you did a sell, it's going to ask you that. You're going to enter the asset class that you were trading. whether it was an indice, whether it was a currency pair, the name of it, the lot size, what price you got in at. Did you set a stop loss price? You could put that there too. If you didn't do a stop loss, obviously you leave it blank. What was the price that you took the profit? Did you win the trade or did you lose the trade? It's going to ask you that. I also have how many pips did you win? What was your profit or your loss? You're going to put that in there and it runs the total. So if you look down at the bottom, you will see a sum of how much money you have made, you know, since you've been doing your trading. I also put in here, how long was I in a trade? You know, was I in there 2 minutes, 10 minutes, 20 minutes? I need to know that. What time period did I trade? What strategy did I use? And then also I have in here some notes. You know, what was my results? What was my feelings? I think it's so important to write down how you felt, because a lot of times you'll notice, and me myself went through this a couple of days ago, that when you're not feeling well or your mind is not in the right place, you will find yourself losing in trades. And so what I like to do is I like to, I mean, you can set up as many databases as you want. You can have a demo one, and you can have a live one. So yeah, you can actually, once this database is copied to you, you can duplicate it and then name it something else. So you can have a live one and you can have a demo, and then you can have a screenshot. So this is literally like the grid view, but in this left-hand side here, this is the grid view, or you can click for the form and it gives you a form view. And so right here, let's say, I'm just going to do an example. Let's say that today I took a trade. So we'll say the 29th, and I'm going to say that I took a trade. I don't know, even though I do X time already, so that's redundant, but I'm going to say 9 o'clock. And let's say I said I did a buy. I'm selecting that. My lot size, I'm going to put 0.01. Let's say, I don't know, I'm just going to use this example. My entry price was 10,500. Okay. And let's say I didn't have a stop loss. My take profit was 10,550. All right. In this example, I won clearly. So I'm going to select the drop down box. It was a win. How many pips? I caught 50 pips. How long was I in the trade? I'm going to say 20 minutes. The time period that I traded the 7 a.m., 9:30 a.m. session, because it matters. You'll start to notice that when you win in certain time periods. My trade strategy that I used, my Powerhouse Scalp, is if the candle crossed above or below the moving averages. That's the Powerhouse Scalp. A counter trade is if I did a trade against the trend. Okay, if I did that, I want to say it. Okay, range trade, did I do a trade because the market was moving sideways, so I traded in the box? Or did I trade because the actual lines crossed? So I did a bullish or bearish cross trade. So I picked what trade strategy, what did I do? Okay, most of the time, majority of the time, I'm sticking to my trade schedule. So I'm gonna say Powerhouse Scalp. And then today I'm gonna say, you know what? I felt great. I felt great, you know, markets moved where I thought it would go. Okay, who knows? Just using that as an example. The next thing that I can do is I can take a screenshot of my chart from my phone, from my computer. I can do a print screen. You can also access this Airtable from your phone. So you can clearly do a picture from your phone if you're trading on your mobile, or you took a picture of your screen from your phone, you can do that too. But let's say I want to attach a file from my device. So I can take a picture And I am going to click, I want to select the upload, and I'm going to go to Forex, and no, where I want to go. I want to go to pictures, and I'm going to go to Forex, and I'm just going to pick this picture, and I'm going to click open. That picture is now attached. I'm going to click upload, and then I'm going to click submit. Oh, did it not let me do this? This sucked after I just put all this in here. I am not finna go to the thing here. Hey. So they making me pay for that. Okay. Let me go my grid. Let me do it real fast. Hey. I feel like doing this right here. So I'm picking today. Oh, not January. Where did I get January from? So I'm just gonna put this. I ain't got time. And I'm gonna put, I did it by my asset class. I traded the indice. I traded NAS 100. My lot size was 0.01. My entry was 10,500. No stop loss. My take profit was 10,550. Had me do that form for nothing. I won. My total pips is 50. Okay, and let's say with them 50 pips, I made $500. I'm just gonna put that in there. So it's whatever your profit was. And as you can see at the bottom, it says my sum, which is gonna add up all the rows as you can continue to add transactions. How long was I in the trade? 20 minutes. What time period did I trade? Traded the morning session. Had me go through all that. Trade strategy used. I did the Powerhouse Scalp. I felt good. And then I got my screenshot. Again, drop it in here, attach my file. Geez. Put my picture, open, upload. Okay. Oh, come on already. And I'm done. My transaction is there. And every day that you take a trade, no matter how many trades you take, go ahead and put it in your entry. You'll be able to track your money. Obviously, what your profits is on a rolling total. And then if you ever want to go back and you want to be able to look at pretty much what you did, you'll be able to click on it and it'll pull up the chart of the trade that you took. Okay, so I thought this was a pretty good tool here. So I want to definitely share it with you guys because I'm used to journalizing in my book. And it will automatically save this for you. And then you're done. And obviously, I told you that they did have other options where you could pay a monthly fee to be able to do other functionalities. So obviously, if I want to use the form, I got to pay them $20 a month. Okay. So it is with the free form, you could do this grid. Okay. So I hope this helps everybody. And so, like I said, I'll be showing you how to import the link. And once you import it, a box like this is going to pull up. And all you got to do is click on the top. And you see how I highlighted this? Name it whatever you want to name it. And then that way it becomes yours. And let's say somebody asks me, can you do a demo? And then can you do a live one? So clearly, you can call this one your Scalp demo, and then you can hit duplicate base and then rename that one Scalp Live, okay? And so that is pretty much all that we have to do. And one more thing that I do want to mention with the charts. I've had a number of people ask me, how do I add a asset class to my market watch? So if you are in your Hugo Sway account, you scroll down to the bottom, there is empty white space. Click in the empty white space and you're gonna see a search box pop up. And then you can type in the asset class. So US 30 will pop up, you hit enter, it'll add it to your list. Okay, some people ask me that, so I just wanna make sure that you understand how to add it on the desktop, okay? All right, and obviously the one with your phone is easy because you see the little add a button. So that's how you add different asset classes, different stocks to your watch list. So everybody, again, get your chart set up if they ain't already set up. Make sure that you're paying attention to the markets, understand the market structure, okay, and then know when you got zoom out of your charts. So you'll be able to see when a market is trending and when a market is moving sideways, okay? The dotted indicator is called a Muku cloud. So if you actually look at the training video on how to set up your charts, I'll show you how to add all of this. And so I will be talking about those clouds and the RSI indicator next week when we go over candlesticks, okay? All right, you guys, we went a long time today. We are out of here. So thank y'all, thank y'all, thank y'all. The replay will be posted tomorrow and you guys can rewatch. So go ahead, know your market structure. Tomorrow, drop in the Facebook group what you think the structure is doing and take a practice trade. That's it, that's all. See y'all next week. Bye, bye-bye. Val, I don't know what you talking about, girl, but bye. Yes, I see you. Bye. I don't know what y'all talking about. I know it ain't Forex. I don't know what y'all talking about, but it ain't Forex. I'm going to find out. See y'all later. See y'all later. Good night. Good night.